Okay, let's dive into Stanley Black Decker's latest earnings report. Honestly, it tells a fascinating story of a company in the ring, taking some hits but landing some really powerful counterpunches. So, right off the bat, we're looking at a major contradiction. On one side, the company made more profit than Wall Street expected. That's a clear win. But on the other, their total sales, the actual money they brought in, well, that came in lower than predicted. So you have to ask yourself, how does that even happen? And here are the hard numbers behind that contradiction. You can see they beat their profit target. That's the earnings per share by 14 cents. That's solid. But their revenue, it missed the forecast by almost $96 million. So let's solve this little mystery, shall we? So really, how can a company succeed and struggle at the exact same time? How can profits actually go up when sales are going down? Well, to get to the bottom of that, we first have to look at the challenges the company is up against. And that brings us to the major headwinds Stanley Black Decker is navigating. Just think of these as strong winds blowing right in the company's face, making it that much harder to move forward. These are kind of the villains of our story here. First, you've got these significant tariffs, which are basically taxes on imported goods, and they're making everything more expensive. Then, they actually sold 7% fewer items in the fourth quarter. And on top of all that, the retail market in North America is just soft. Shoppers are being cautious, and they're hunting for deals and promotions instead of paying full price. The company's CEO, Chris Nelson, he didn't really mince words. On the earnings call, he acknowledged this whole tough landscape, pointing out the need for disciplined execution in what he called a constantly shifting world. I mean, that's a direct admission that the game has gotten a lot harder. So, facing all these challenges, the company didn't just sit back and take it. Nope, they launched a counterattack. And understanding their three-part plan, well, that's the key to solving our entire mystery. Their whole strategy really breaks down into three clear pillars. First, getting lean, which is all about cutting costs. Second, getting focused by simplifying the business. And third, getting smart to deal with those really punishing tariffs. So let's start with getting lean. And look, this was not a small effort. The company completed a global cost reduction program that slashed a massive, get this, $2.1 billion in pre-tax expenses. And this is a huge reason why profits looked good even when sales were down. They just spent way less money to operate. Now for pillar 2, getting focused. This involved a pretty big strategic move. They sold their CAM aerospace fasteners business. Doing this helps them simplify everything and really concentrate on their core brands, the ones we all know, like DeWalt, Craftsman, and Stanley. And that sale, it wasn't for pocket change. It brought in around $1.8 billion in what's called gross proceeds. That's the total before any expenses. The key goal here wasn't just to get a pile of cash, but to use that money to pay down debt and make the company's financial foundation a whole lot stronger. The third pillar, getting smart, is all about proactively fighting back against those tariffs. As the company put it, this involved aggressive tariff mitigation actions. So that means things like moving production around and raising prices strategically to offset the higher costs. It's kind of like finding a new route to work just to avoid a super expensive toll road. All right, so with this three-pillar plan in full swing, what does the company actually expect for the future? Let's take a look at their own forecast for the year ahead. So you can see the journey they're mapping out. They expect the first quarter of 2026 to still be a bit bumpy. But as all that cost-cutting and strategic focus really starts to kick in, they see sales trends improving in the second half of the year. And that should lead to overall revenue growth and a really healthy jump in profits for the full year. But the 2026 forecast, that's really just one step. The company has also laid out a much bigger, way more ambitious vision for the long term. This is the ultimate destination they're steering the ship towards. So here's the crucial point. All of these tough choices, the cost-cutting, the business sale, they're all designed to hit these targets by 2028. They're aiming for steady sales growth and, maybe more importantly, seriously impressive margins. That just means they'll be keeping a much healthier chunk of every single dollar they make as profit. It's all about building a stronger, more efficient company. And this kind of leaves us with the final thought. The company is clearly in the middle of a massive transformation. They're betting that this short-term pain of lower sales will lead to a significant long-term gain in strength and profitability. The big question now is, will that bet pay off?